We've had a rough few days, but today we bounced. So we'll break down today's bounce to see if this is the start of a new intermediate run, or are we going to get any more weakness in the short term, or will that weakness turn into something more in the intermediate term? So I'm going to break all that down using the market forecast and technical indicators, talk about what's driving the price action today with a bullish trade idea. So let's go ahead and get started. Today is Tuesday, June 26th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you for tuning in. Glad to have you on board, especially those watching for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the logo in the bottom right corner of your video player. Click that red subscribe button that pops out there. Click the thumbs up icon that's down below the video. That lets me know, number one, that you like today's video. And number two, it tells me with one click that you want me to do the video again. It's a quick way to give us feedback. You can do it right now while you're watching. Comment on anything that stands out to you from today's video. Join our Market Outlook email list. There's a link that's popping out in the top right corner. Click on that link and subscribe to our email list. Follow on Twitter for more content like this, and also join our Market Outlook community on Facebook. All right, let's take a look at the S&P 500 first with the market forecast indicator. You can see we still have a rising market sentiment, so that orange line is barely rising. We are pulling back here on the intermediate posture, though. Intermediate line still, despite today's small bounce, 6-point bounce, a little bit below average, slightly below average volume. You can see the bounce off of this low yesterday, which basically we continued today a little bit, kept the short-term sentiment lines pointed higher, so they're both rising, and they're also both avoiding the reversal zone. And also what I failed to mention yesterday was the near-term line is forming slightly higher lows here. Obviously, from where my cursor is up here, this is not a slightly higher lows on the index itself. So we're getting lower lows heading into support, Fibonacci support, as well as that old high point that I've got notated with the blue line. You're getting a bullish divergence heading into that support there. Again, you expect support to hold until it doesn't. Now we might come down to 2,700 because there's, you can see there's a range of support here between the 50 and 23% lines. And there's also a low point in yesterday's long lower shadow right there at 2,700 as well. So we might come down a little bit more. Who knows, right? But as we test the support, but eventually we expect it to bounce off of that, and the confirmation will come as of right now when we close above this day's high point, which is right there about 2743. So you'd have to get up to 2750 or higher. Basically get back above that 23% Fibonacci retracement level, and then you would expect higher highs, right? You're coming up off higher low points. And depending upon how quickly we do that, if it takes another couple of days, you're probably going to get the intermediate line dipping below 50 like we did over here, which will start a new intermediate run of 1 to 3 months. Again, like we've mentioned, when market sentiment lines come up from below 50, you expect multiple intermediate rallies. Doesn't mean we have to get them. It's what we expect, and then we look for things to be different than what we expect, and that's we change what we do. But as of right now, we expect it to hold that support. We expect it to bounce. The intermediate line may dip, start a new 1 to 3 month intermediate run, and we'd expect to bounce up to higher low points, especially coming off of 38%. Pretty good odds that would bounce up to higher highs, which would be above 2,800. Would be testing that 2,872 level again for a high point. You look at the Dow Jones Industrial Average, it's also sitting at Fibonacci support. This one's a little bit deeper though, at the 62% Fibonacci retracement, still holding the close there, and this is also happens to be the near-term, a full near-term retracement. That's the old near-term low point. The other Fibonacci lines that we've got drawn. Still bearish. Short-term sentiment still setting up for the divergence, heading into that support level. And then, of course, the market set both these short-term lines avoiding the reversal zone, oversold territory. The intermediate posture is pretty darn close. And you can see it doesn't get below and stay below. If I were to go out a little bit further, so we can see we can see multiple instances here. When the intermediate line, you see the green line, doesn't get below and stay below the 20 very often. You can see it gets down really quickly. If I zoom in, you can see how it dips down there and then comes right back up off of it. I'm just looking at these green lows as we pass by. That was probably the deepest one that we had in early 2016 when we were below the 200-day moving average. So zoom back out. There we go. There's your 2016. We were below the 200-day moving average there, and same thing back here in October 14 when we had our dip to the 200-day moving average at that point and bounced off of it. All right, finally we'll take a look at the NASDAQ, also sitting at 38% Fibonacci, a little bit higher. Bearish sentiment with improving short term. Of course, now the Russell, which has been outperforming, it's got that, the market sentiment's falling, but it's right at 80. It's barely falling. It's got a weak bearish posture. We've been bearish for a little bit longer because we didn't dip below 50 here. It's not below 50, so we're actually not ending the run yet. Right? It's got to get below 50 before this run ended and we start a new run. But regardless, you can see, we're sitting at 50% retracement of the near-term run, still sitting above the moving average. And as I mentioned before, we are at the 23% essentially Fibonacci retracement of the intermediate run that actually, started back here. Move that up to there, to those clusters. So, so again, 23% Fibonacci retracement. So, and 38 to 50, you've got strong support in there. So, yeah, we've had a little bit of a pullback here, and we needed a pullback, especially on the Russell, because it was up almost every day, and that was different than what we saw in the S&P and the Dow. So, because we're getting more finally of an exhale here that's bigger because of how big that move was, just looking at that move by itself, again, we're still not even the 38% Fibonacci retracement of that move. So, that shows, we needed this to happen, and it wasn't happening, and that's why we're seeing kind of broad, solely from a technical perspective. Of course, there's macro factors leading to the sell-offs, but in terms of creating the environment for stocks to be weak, for this macro to have that impact, the environment was a really overbought environment. Multiple clusters in a row, that we typically don't get. 4 overbought clusters, back to back like that. So we needed a pullback, and that's impacting the broader market. It's hard for the S&P to get going when the Russell hasn't pulled back yet. Now we're getting it, and now it's setting up that possibility for all stocks and the risk appetite to take another bounce again. All right, really quickly before we look at the other charts, again a reminder, we look for 3 clicks every day from you, to tell us you want us to keep doing these videos. Those 3 clicks are, number 1, liking the Market Outlook tweet here. It's embedded, but you can just, again, you're watching it right here, scroll down the page and click on that tweet. Number 2, click on the thumbs up there for Facebook. If you have a Facebook account, click on that thumbs up. It'll open up a new window and ask you to log in if you're not logged in there. And then the third one, liking it here. Remember, if you're not subscribed to our daily Market Outlook email that shows you today's overbought and oversold clusters as well as a timestamp summary of this video, make sure you do that here. Above the video is a link to the forum, so you'll see that at the end of the video as well. I also wanted to mention this. Again, this discount offer here ends at the end of the week. If you click on that link right above this this link here takes you to this page. The sign-up form is at the bottom of the page. I'm already logged in. If you're not logged in or you haven't subscribed for free on the site yet, you'll see a place for email and your password and all of that. There's a few things I added here, actually just today. Number 1, you see at the bottom, people have been asking for some samples. And we actually did record back in March some samples of what our classes are. We have 10 classes, so this is a small sample. But here's a Q&A session that we produced talking about what our plans are for this company and our website, and our long-term, short-term and long-term plans. As well as 4 sample classes, preview classes for 4 of the 8. 2 of the 10 classes are Q&A sessions. So this would be 4 of our 8 classes, including Brandon's very popular dividend growth investing class, as well as my technical analysis I do every Friday. And this class I do actually later tonight on Tuesdays. So the other thing I wanted to highlight too is now you can actually, we've been getting a lot of questions about can we pay with installments, and the answer to that is yes, but not through us. If you have a PayPal account, and if you don't have one, you click on this link to create one. If you have a PayPal account, then if you scroll down here, and by default you pay with a credit card, but if you want to pay with PayPal instead, click on that, fill out the form, click on that, click here to pay, and then there will also be a terms and conditions that you have to check too. Then click here to pay. Then it'll open up the PayPal page. You log into your PayPal account, and then there will be an option there to pay to apply for a PayPal credit, to where you get you can spread out the $19.99 over 6 months with no interest. So I wanted to highlight that and make sure you're aware of that. We've been getting a lot of emails about that possibility, and PayPal just made that available for us to offer to any potential clients. All right, back to the chart. So you can see again, we bounced up a little bit today, but we're still below the 50-day moving average. So we still have the green arrow on the red arrow, on the S&P 500. We're below the falling 50-day on the Dow. The Russell we're still up above despite the pullback, and so same with the Nasdaq, and the same with the Russell. So and they have very strong momentum levels. And remember how it's hard to fall off a cliff from very strong momentum levels. We can, and when we do, we typically bounce right back that fast. So if we do fall off a cliff and drop sharply below here, that will be the buying opportunity of the summer. Until then, we tend to grind. This we can move. This is going to move its way towards zero, but it's going to move it slowly through lower highs and lower lows and get much closer before you fall off the cliff below the 200-day moving average and to stay down there for a while. If you take a look at the 3 green arrow chart, you can see the S&P still got 3 red arrows, so we're still pink. We're still below now a falling moving average, so the line is red there. You can see too the Dow Jones Industrial Average, same thing, 3 red arrows. MAC Stochastics is strongly oversold. Those sellers are in control. The Nasdaq, the Stochastics is just barely crossed below 50. It's got 3 red arrows as well, and the Russell 2000 has not formed 3 red arrows, so it's still got 2, so no pink shaded area there. Looking at the 2-line version of the MACD and the Stochastics, you can see the MAC, they're both below their moving averages, and as of right now, still pulling away. So we still don't have that sign yet, and that's why I say we might even have another day or two where we kind of bounce around this range and maybe even into the low point before eventually we come back up and make our way up to and start that new intermediate trend, enough to bring the intermediate line down below 50, like the Stochastics has gone down below 50. All right, if you take a look now at our intraday chart, you can see the S&P, we're a day away. So this is going to pop off tomorrow, and this is going to be the new 4-week low point, yesterday's low. So we are that, and then the 4-week, the midpoint, the dotted line here in the middle is going to move off of last week's low point, and move up a little bit higher. It won't be significant because that's not a significant jump, but it'll move up a little bit higher there. And now you kind of see a bearish kind of pattern where the high is, instead of the high being over here and the low being over here, the high is gravitating over to the left and the low is closer to the right. And so that's a little bit bearish. And like I said, it's a little bit bearish of a sign. We have to get back above that midpoint before we're now back to like being more bullish in the short term. So, you think you're still long-term bullish. We still got the green shaded area that the 50 is above the 100. But we don't have the market forecast is showing light pink. We got 3 red arrows, so we're showing pink on the 3 green arrow chart, and now on this chart we're in the lower half of the chart, which is also bearish. So not bearish enough to be to be overly biased in our active trading account to the bearish side, but bearish enough that being cautious on any bullish trades and probably holding off in any bullish trades until we get some more confirmation of things turning around. You can see if I go back to the 3 green arrows charts here and look at SPY, you can see the trading range was below 2.5 points, the ATR. So we were below average on the trading range, and the volume you can see down here too was just a little bit below average. Average at 74, and we're at 68. If you take a look at, again, we are below the absolute value in ATR, and you can see the average, the relative ATR is still below 1%, which is still in bullish zone. And you can see the volume was back down to being low levels, and it wasn't really, well, we had a high volume, but it was kind of higher, a little too high, and especially the range yesterday was also, including the gap, a little too high to sustain the bearishness. A lot of sellers came in, and it brought out the buyers too far, too fast. We've seen that many times before, and we've outlined that here in this video. Looking at the volatility chart, let's look at this one first. You can see volatility came down to 15 to new support, bounce off of that. 15 can act as a layer of support or resistance depending upon which side we're on. So as of right now, bouncing off of that, now you notice it would be a higher low point. So we'll see if this ends up pushing up through 20 on the next go around, which would be really bearish. Obviously would require some support breaks where we're expecting that support to hold on some of these charts. So we'll see if that ends up happening. Of course, if we roll over from here, form a, in the short term, I remember how I said that we might have another day or two of short-term weakness, trading around in today's range, maybe in the low end of yesterday's range, in that long lower shadow. That might mean volatility turns up a little bit and stays between 16, 17, maybe 17 and a half, forming a lower high point, and then trending lower and getting back below 15 into these levels again, where we'll start a new bullish intermediate run. And that's on an absolute basis, and then on a relative basis, you can see same thing. We bounced late, but we are still in the neutral zone. So again, kind of nullifies how bearish we are when we are back down below that 95% level. We might trade around this 95% level. If we get back up to 1, then we're probably going, we're going to probably make a move back up to 20 or higher, and be, kind of be more bearish than what we're expecting. Otherwise, if we kind of bounce up here in the near term and we stay around in this higher end of the neutral area and hold that for resistance, then that's what the pattern will look like as we start a new bullish intermediate run. So that's what I expect, because we are, the market sentiment line's rising above 50, and we just finished one run, and usually market sentiment rallies, long-term rallies, are multiple intermediate runs. So we expect another one or two more before we start showing a long-term weakness and a long-term pullback. So it doesn't mean that has to happen, because things don't always turn out as you expect. But if you never expect anything, you don't trade, right? Every trade you make and everything you do is based off of expectations, and these are the expectations we have based off of the chart. So now I ask you, with this link that's popping out in the top right corner here with that poll, what do you think about the market posture that we are currently in an intermediate pullback and setting up for a new intermediate run here with this short-term weakness? That may last another day or two here, regardless of what the news says, but just from a technical perspective, that's our current posture. So do you agree with that? Do you disagree with that? And you wouldn't hurt my feelings if you disagree with me, but I'd love to hear what you're looking at and what you're seeing down below. Seems like the most common disagreements has been that I talked too much, or that I looked really ragged on Friday, which I totally understandable. Friday was a long day. But comment down below on if you are more bearish than what I this short-term weakness that I've been kind of talking about. You're expecting more bearishness. Share with us what you're seeing that would give you that posture. All right, now let's talk about what's driving the price action today. You can see there's a few things on the economic calendar. Consumer confidence came in a little bit below estimates, below what it was, but still at relatively high levels. Case-Shiller home price index growing year over year 6.6%, a little bit below the estimates and below where it was before, but still at relatively high levels. So the economic surprise index starting to move its way towards zero, so kind of more neutral, not really positive or negative, but on the downward decline, whereas G10 economies are starting to improve from being very, very negative, especially in Europe. You got one more day for the GDP estimates to be updated for tomorrow. You can see the odds of the rate hikes, so still about the same, so nothing's really changed, a little bit down from where we were a week ago. But still, you got about 75% chance we'll get a rate hike in September. And then in December, we have still about a 48% chance we'll get that second rate hike, fourth for the rest of the year. And remember, starting in January, they're going to have press conferences at every meeting, which they've kind of held off on doing any policy changes, any rate hike decisions without press conferences. So they've kind of held them to March, June, September, December when they've had those scheduled, and where they can give the forecast and all that. Well, now they have in January, they'll have there's only a 7% chance that we'll get a rate hike in January, but the possibility is higher from a logistical standpoint because they'll have a press conference starting every meeting in January. So we'll see how that starts to impact those probabilities going forward. But as of right now, just 75% chance of one in September, 50% chance of one in December. Nothing's really changed there. If you take a look at the major assets and how they performed today, there's one big outlier, and that was crude oil. And with news that the U.S. will limit imports from Iran, crude oil jumped up 3.5%. That's a tremendous move. If you take a look at what's going on here on its chart, this 2 days in a row now that we're getting big spikes higher in crude. Of course, commodity basket, that's going to impact commodities as a whole and countries that are more tied to commodities. So, and inflation. So that can also impact things. But you can see it's really starting to make a strong move higher. In fact, over the last 2 weeks, it's up 7% again. So after being kind of flat since that beginning time frame. So a lot of that move coming the last 3 days, small pullback in the middle. If you take a look at just today, IWM was up. That was the only other thing that outpaced the dollar. So the dollar was strong today, and that put pressure on emerging markets and put pressure on gold. That's what you'd expect. Again, not too often that you get crude oil and the dollar moving hand in hand. The dollar kind of bouncing up off of what can be a higher low point. We'll see if that continues to be the case. So we got 2 red arrows on the dollar. Of course, from a long-term perspective, it's been really bold. The 50-day, it's just barely crossed over the 200-day moving average. And, of course, a lot of talk. There's been a lot of chatter about the death cross that you're getting this week on the on gold. So you can see it's turning pink there because the 50-day is crossing below the 200-day moving average. That's a direct result of that strong dollar. We haven't dropped below that lower low point yet, but still pretty bearish. We were close to being that bearish back at the end of 2016. So those are, that's what's going on with the major markets. If you take a look at long-term bonds, they're continuing to hold up. This is the long-term bond prices. You can see they're holding up there on a long-term basis. On the 3 green arrows, you can see we got 3 green arrows. We're above a rising moving average. We still got to break through that 122 level before we trend higher. So we'll keep our eyes on that. But, there's still bullish sentiment there for that safe haven asset. Again, zoom out a little bit. You can see those two have been outperformers over the last couple of weeks. The dollar and long-term bonds both up. And again, you can see the impact that has on gold as well as international stocks, in particular emerging market stocks. And we can see that impact especially here. In fact, if you take a look at the foreign markets, and again, I've got them listed here by the size of their economies. And you can see over here, Canada had the best day today. There's 3 countries outpaced the dollar. There's the S&P 500. So Canada, Great Britain, and Japan all holding up and outperforming with smaller gains. You can see on the other end of the spectrum, Brazil and Russia, India, and Korea kind of lagging behind with Germany. In fact, Germany had a oversold cluster. We did get one on Italy and France. So this is EWQ. That would be France. EWI would be Italy. I know we haven't updated these labels yet, but we will. So you got oversold clusters there. You got an oversold cluster on the UK as well. I mean, they are sharply below moving averages. Germany was too at its low point. So, I mean, they've been pretty darn bearish here. You can see Korea has been bearish. Japan has been sharply bearish. China, so the Asian economy is also struggling in conjunction with each other with this tariff news. India down a little bit today, but holding its value still, not dropping the lower lows. Canada, as I mentioned, Canada was a strong outperformer today, but still below a falling moving average. So a Harami pattern though, so there's opportunity that we can bounce off, and this would be more correlated with crude oil. So there's opportunity there in Canada, and you can see Brazil down, one of the bigger ones down, but still looks like it's trying to base inside the range of that long lower shadow where my cursor is here. So it didn't take long for the safety trade to turn itself around. You can see this looking at today. Now, granted, it's been a very outperformer over the last 2 weeks. There's utilities up 6%, staples up 1.5%, and real estate positive with the market down more than 2% over this past couple of weeks. Industrials and materials, the tariff-related sectors being dragged down the most. Financials also struggling with the falling yield curve. And, of course, discretionary and technology, your previous market leadership pulling back. If you take a look at just today, though, remember how as safe havens were yesterday, it's kind of the flip-flop. Today, all your safe haven assets are down at the bottom. You can see that over here on the left, too, including financials, which continues to lag behind. Here's the sectors sort of in the order of performance. The S&P is right here. Everything above the S&P is outperformed today, and everything below it is down. You can see some of the outperformers. There's your two tariff-related areas have been so beaten up below falling moving averages. Discretionary, is bouncing off of a rising moving average, and real estate is also above a rising moving average. Technology trying to hold similar to the S&P 500. Utilities lagged a little bit today, but still, breaking up above new highs. Staples, same thing. Still rising above a moving average, slight pullback, and healthcare as well, pulling back to support with the opportunity to bounce there. So yeah, there's these three safe haven areas down here in the bottom right corner, kind of lagged behind, but they're still strongly bullish, and real estate's up there too, along with discretionary. Whereas things like industrials, materials, and financials, they're really areas to avoid right now, being so far below, a falling moving average like they are. Doesn't mean they can't bounce, but they're below support, and they're below, they're down, all three of them down the lower lows. That there looks to be rotation into some better opportunities right now as we focus in these areas in previous trade ideas. All right, if we take a look at our trade idea of the day, you can see one of the stocks that may be showing a bounce back already that we expect, whether it's another day or two on the market as a whole, is Twilio. And you can see a nice little bullish pattern here. Now, it still shows a bearish posture, but you can see its short-term lines rising. It's got strong market sentiment, so strong long-term trend. It's got the near-term line bouncing back up above. So that's a positive, and you can see a little bit of a morning star candlestick pattern developing, closing above the high of the low day, bullish reversal pattern in the short term off that level. From this near intermediate point here, from this low point that we had that almost got the intermediate line down below 50 up to that high. You can see essentially getting close to that 38% Fibonacci retracement, where there's going to be some support in that area. So basically we held kind of that area between 38 and 23% Fibonacci retracement as a support, came into it, bounced off of it as of right now at least. And so we can say, okay, well, again, as like to sell puts when you're not so strongly bullish versus say buying calls. We've been doing some more trend trade, long stock trades here in previous classes. This one I'm not. We've already been so bullish for so long, and we still kind of need the market to make its bounce up higher into this July expiration peak that we expect from a seasonality standpoint. So we'll say, okay, well, this is a trade until that July expiration. See if we can take advantage of some bullish seasonality from the broad market as a whole to help this out. We'll sell at that 30 delta. In this case, it's a smidgen below 30. You can see, depending upon where you get filled in at, you can get priced in close to where we need it to get a 30% return on risk. And then you can see the blue line is where the break even would be. There's your break even. So high probabilities. We have a 33% chance of closing below that level, but a pretty decent chance of touching. And of course, the touch area would be where this crossover occurs. So we have a 60% chance that we can touch there, and that's where we would take our loss. And again, the idea being that at 53. If I set that slice to the chart there, that's at the low point of this little reversal pattern. So we'll see if we end up pulling back down to there, take a small loss, move on to something else. If we hold it and continue higher and hold the 54 level out of the money, then we make a quick and easy high probability trade on the stock that's got, a bullish pattern, bullish trend, and a bullish pattern suggesting, the possibility of a bounce coming up from here. And of course, eventually the market bouncing would help all tides raises all boats, so to speak. I can't think of the expression right now, but you get the idea. And of course, the seasonality would end right when this trade would end. That bullish seasonality would end right when this trade would end. So that's our trade for today. So love to hear what you think about us. So go to the forums. There's a link popping in the top right corner of the screen. Click on that link. Let's talk about today's trade idea. Let's talk about our market posture. Questions, comments, post in there. Post a new topic in the forum. If you see another topic you want to reply to, go ahead and reply to that as well. Thank you very much for watching. Appreciate your time tonight. Remember to subscribe to our YouTube channel, like today's video, and comment on anything that stands out to you. Also remember to follow on Twitter for more content and join our Facebook community our Market Outlook community, on Facebook. All right, that being said, thanks again. Have a great one, everybody. We'll see you all next time.